In this video, we will discuss how to organize and implement a capitalization policy to best benefit your small business. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. Though creating and employing a capitalization policy for your child care business may seem complicated, there are many worthwhile benefits to doing so, not the least of which is complying with U.S. Internal Revenue Service requirements. A good capitalization policy can help your business approach large expenditures with consistency and allows you to categorize many purchases as expenses, and which would therefore be deductible in 1 year. In today's conversation, we will explain what a capitalization policy is, why you need one, and what to include in your policy. In accounting, you typically treat any large purchases or those items with a life of more than 1 year, like a dishwasher or furniture, as a capital expense. This means that even though you paid for it this year, you will need to deduct the cost over many years. This is called depreciation. For example, let's say you purchased a couch used exclusively for your child care business for $700. Even though you paid for it this year, you would only be able to deduct $100 a year over 7 years. That means that even though you spent the money this year, you'll pay extra taxes on it. This would be a challenge for small businesses, so the IRS created a safe harbor that provides an exception if you have a capitalization policy in place. With a capitalization policy, you can say that any item you buy which is less than $2,500 can be treated as a current year expense, even if it has a life of more than 1 year. In other words, the policy allows you to skip depreciation for items less than $2,500 and deduct them this year, keeping your taxes lower. Typically, most small businesses opt to create a capitalization policy at the highest limit, which is $2,500. You can set it lower, but this level allows you the greatest advantage on your taxes and in your bookkeeping. Creating a policy is very simple and takes only 3 steps. First, create the policy. Next, sign and date the policy. And finally, file the policy. When creating your capitalization policy, you should include the following items. Clearly state the purpose of the capitalization policy, which in this case is to establish the minimum cost, or capitalization amount, for recording capital assets in the company's annual financial statements. Provide a clear definition of what constitutes a capital asset. Typically, you will want to include items with a useful life of more than 1 year and a cost of $2,500 or more. Set the threshold amount for minimum capitalization. Outline the method and procedure for capitalizing assets. Be sure to specify the record-keeping requirements. Here is an example of how to use these 5 categories to develop your own policy. The purpose of this policy is to establish guidelines for recording capital assets in the company's financial statements, ensuring consistent and appropriate treatment of these assets. A capital asset is defined as a tangible, such as a physical item purchased, like a refrigerator, or intangible asset that has a useful life that extends beyond 12 months and was acquired or produced for a cost exceeding $2,500. The threshold for capitalization shall be set at $2,500. All assets meeting or exceeding this cost must be capitalized, while assets below this threshold shall be expensed during the year it was purchased. Capital assets will be listed in records at the price they were bought for, which includes all the costs needed to get them ready to use. If a tangible asset costs less than a certain amount, it will be counted as an expense in the financial records in the year that it was bought. Capital assets that wear out over time will have their value spread across their estimated useful lives using standard depreciation methods. The amount that they lose value by each year will be noted in the financial records in a regular and organized way. All supporting documentation, including invoices, contracts, and relevant financial records, validating the total cost of capital assets, must be retained for a minimum of 4 years from the date the asset is disposed of. This capitalization policy shall be periodically reviewed to ensure its relevance and effectiveness. Sign at the bottom of the policy. It is important to have as a record in case of an IRS audit. So even if you are a sole proprietor with you as the only employee, you should still sign it. Keep both a paper and an electronic copy of the policy just in case you need it in an audit. This can be as simple as keeping a paper copy in your files and taking a photo of it for a digital version. Even though it may seem like some extra steps, creating a capitalization policy will allow you to legally expense many more items and have a clear reason for doing so if you are ever audited by the IRS. For more resources on early care and education, visit the Wisconsin Early Childhood Association website at wisconsinearlychildhood.org. If you are not yet a member of the Wisconsin Early Education Shared Services Network, visit wisconsinearlychildhood.org/programs/WEESSN to find out about the training and business support it offers. And be sure to visit the Civitas Strategies YouTube channel for more valuable resources to support you and your business.